Welcome back to The Explainer. Today, we are firmly putting on our expert investment analyst hats because we are going to subject a highly debated high-growth clean energy stock, FuelCell Energy, to an absolute analytical gauntlet. We're going to evaluate it using history's most legendary investing frameworks. We'll run it through the strict value principles of Benjamin Graham and Warren Buffett, apply the growth at a reasonable price lens of Peter Lynch, and then build out modern discounted cash flow and Wall Street models. Let's get right into it. Here's our roadmap for today. We'll kick things off with a quick company snapshot, then run the stock through the classic Buffett and Graham value lenses, pivot to Peter Lynch's growth perspective, build out a DCF model, check out some alternative Wall Street models, and finally, wrap it all up with a synthesized recommendation.
All right, Section 1, FuelCell Energy Company Snapshot. Let's get the core facts on the table.
So looking at the ticker, FCEL, it is currently trading right around $27.86. And just as a quick note, that factors in a recent 1-for-30 reverse stock split. What's their actual play here? Well, their core value proposition today is delivering rapid, continuous, off-grid clean power specifically for AI data centers using molten carbonate fuel cells. And this is huge right now because AI hyperscalers simply cannot afford to wait 5 to 7 years for traditional grid interconnections. FuelCell basically offers a modular solution that bypasses those gridlock delays entirely. Moving right along to Section 2, the Buffett and Graham lenses. Time to break out the classic value investing framework. We have to begin with the godfather of value investing himself, Benjamin Graham. Running FuelCell through Graham's defensive investor checklist reveals a really stark contrast. On the plus side, the company absolutely has adequate size, boasting a massive $1.17 billion backlog. But honestly, that's kind of where the good news ends for Graham. It completely fails the earnings stability test with a Q2 net loss of $78.71 million. There's no common dividend record to speak of, and it obviously fails the moderate price to earnings test because, well, the earnings are currently negative. However, giving credit where it's due, it does earn a firm checkmark for its financial condition. FuelCell boasts a rock-solid balance sheet with $379.6 million in total liquidity. Plus, they recently secured a $25 million non-dilutive backing from the U.S. EXIM Bank to support international projects. So the financial runway to actually execute on their plans, it's definitely there. So the crucial question becomes this. Considering all those mixed checklist results, what exact intrinsic value does Graham's legendary valuation formula actually generate for FuelCell Energy at this very moment? The answer is zero. Literally zero. See, Graham's classic formula relies heavily on a multiplier of positive earnings per share. Because FuelCell reported a negative EPS of $1.45 in Q2 2026, the underlying math just completely collapses. Under this strict historical framework, Graham would demand a massive margin of safety and completely walk away until they can prove consistent profitability. Now, what about his star pupil, Warren Buffett? Buffett is always looking for that wide economic moat, consistent owner earnings, and a high return on equity. Now, Buffett would actually love their economic moat. Their proprietary carbonate technology uniquely solves immediate AI power constraints, and it even features built-in carbon capture. But he would walk away in a heartbeat due to the financial reality. With a negative return on equity and a staggering $191 million net loss in fiscal year 2025, FuelCell's owner earnings are deeply negative. Buffett requires cash-generating machines, and right now, FuelCell is a cash-consuming machine. His buy price would also be zero until the fundamental economics of the business shift. Let's shift gears a bit to Section 3, the Peter Lynch lens. We are looking for growth at a fair price. Peter Lynch famously relies on the PEG ratio to find growth at a reasonable price. But once again, we hit the exact same roadblock. Without positive earnings, there is literally no PEG ratio to calculate. So we are forced to look at his alternative company categories. And this brilliantly illustrates where FuelCell actually fits into the puzzle. Lynch would likely categorize FuelCell as a high-risk turnaround or a speculative asset play. He'd be looking really closely at the growth catalysts. They're expanding their Torrington manufacturing facility to 350 megawatts. They have this massive 1.5 gigawatt sales pipeline with 80% of it driven by data centers. And you can't ignore the strategic partnerships. They've identified up to 450 megawatts with FCEL and signed a massive 380 megawatt agreement with Fit Energy. Furthermore, while traditional insider buying is a bit light, Fit Energy actually holds warrants to buy 12 million shares that are tied strictly to specific deployment milestones. That aligns partner incentives perfectly with execution. execution. So Lynch would view this as a speculative hold or buy, purely based on whether you believe management can execute that massive backlog. Okay, moving to Section 4, discounted cash flow valuation. Let's build a forward-looking model. Since the historical models totally failed us, we have to project out into the future. Here are our base case DCF assumptions. We're using a 10-year forecast period here because their power purchase agreements are typically 15 to 20 years long. Because they're currently burning through cash, our model assumes a transition to positive free cash flow starting in years 4 through 10, banking on the successful conversion of that 1.5 gigawatt pipeline. We're assuming a 3% terminal growth rate. But most importantly, we are applying a very high 15% weighted average cost of capital. We absolutely have to apply this heavy speculative risk premium just because of the high execution risk associated with their current cash burn. Crunching those numbers gives us a base case fair value of $11.40 per share. But the real story is in the sensitivity analysis. By varying the discount rate and terminal growth, we see a remarkably wide spread of fair values. We're talking anywhere from $5.50 on the bearish end all the way up to over $20 on the bullish end. This proves just how heavily this stock's value depends on management flawlessly executing their 350 megawatt production scale-up over the next few years. If they stumble, the value just plummets. Section 5, Alternative Valuation Models. Let's see what Wall Street thinks. Wall Street generally leans on forward price-to-sales and EV-to-revenue models for unprofitable growth stocks like this. And frankly, analysts are completely divided here. On the ultra-bearish side, Canaccord sets a target of just $1.25, which heavily weighs the immediate cash burn. The overall consensus sits right around $18.03. But then, on the very bullish end, B. Riley models a $32 price target, and Jefferies even recently upgraded them to $24. These high targets are entirely banking on the massive macro tailwinds of AI energy demand and monster deals like the 380 megawatt FIT energy agreement. Finally, Section 6, Synthesis and Final Recommendation. Let's bring all this data together. This summary of fair values perfectly illustrates the ultimate analytical tension surrounding FuelCell Energy. Think about it. If you're a backward-looking value investor like Buffett or Graham, the calculated fair value is zero. The company simply doesn't produce the earnings required to justify an investment today. However, if you look forward, our DCF model points to around $11.40, and forward-looking analyst growth models price in substantial upside, anywhere from $18 to a staggering $32, purely based on the potential of capturing that explosive AI data center market. So blending all of these frameworks together, our final verdict at the current $27.86 price tag is a firm hold for traditional or value-focused investors. The fundamentals just aren't there yet to justify it. However, this is absolutely a speculative buy for high-risk growth investors who want to apply a Peter Lynch turnaround lens and are fully willing to bet on the AI data center energy crisis. Which leaves us with the ultimate question you really need to ask yourself before investing. Can FuelCell Energy actually convert its multi-gigawatt pipeline into real bottom-line profits before the realities of its heavy cash burn catch up to it? The technology is undeniably proven, but the race against the balance sheet is on. Thanks for joining me on this explainer, and keep learning.